In this week's video, we'll cover something extremely rare that just happened in the stock market. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. So, weekly chart of the S&P 500 index as of the close on Friday, April 28th. The rare occurrence is this weekly gap up. It's not particularly rare to have the market gap up on a Monday morning. What is extremely rare is that during the remainder of the week, typically you come back and retest and fill the gap. So if you look at this weekly chart here, this is 2014, 15, 16, and 17. You can't find anything that has a gap like this on it. What can we learn from the rare occurrence? A gap occurs when the market closes on Friday. There's something that the market is concerned about. And when it opens on Monday, what the market was concerned about on Friday, it's no longer concerned about, or something else has improved in such a way it causes the market to gap open. There's somewhat of a spike in demand relative to the supply and demand balance on Friday. The fact that the gap was not filled, if we think about it, typically what happens when the market gaps up on a Monday, typically there's enough selling pressure to come back down and fill this gap. The fact that we didn't fill the gap this week says there wasn't enough selling conviction relative to the conviction to buy or the conviction to hold to close that gap. It's hard to argue that a weekly gap up is bearish. However, in the short run, it's possible that the market will come back and fill this gap, meaning that it would revisit somewhere between 2370 and 2360. You can also see if we drew a weekly trend line, we had a short-term downtrend, a counter trend here, and we gapped above and held above this downward sloping weekly trend line that would appear here on the chart. Since April 28th was the last trading day of the month, we will be reviewing a handful of monthly charts, including the monthly chart for the NYSE Composite Index. This is our long-term consolidation. This is 1997. Price came down in this area 3 times. At the top of the box, price was in the same general area 4 times. Now we've cleared the box for the first time and held above it for the first time in 19 years. The NYSE Composite was able to rally in the second half of the month. It has a new monthly closing high, and it was up almost 0.4% in the month of April. As we review these charts, the 2 overriding questions under our approach are: number 1, does the long-term bullish trend appear to be in jeopardy? And or number 2, do we appear to be in the early stages of a new bear market? NYSE Composite weekly, it was also up on a weekly basis. This was the high in 2015 that we've covered in the past. We have what looks like a bullish breakout, and this appears to be a retest of this area here. And right now, it looks like a successful retest, and this looks like a normal retracement within the context of an ongoing bullish trend. The NYSE Composite stayed inside of this box for 7,093 calendar days. Looked like a failed breakout here. Now we've come back up and we've made a higher high. At month end, we were up and we closed above these highs here. The longer we stay above this long-term box, the more relevant it becomes. S&P 500 daily as of the close on April 28th, volatile price has been removed so we can focus on trends. This is the 50-day simple moving average in blue, the longer-term 200-day moving average in red. The takeaway: we have recently had a pullback and a loss of momentum. However, the 50-day still looks strong. The 200-day still looks strong. Compare and contrast this look to the pullback that we had prior to the U.S. election and this little blip that we had here near the Brexit referendum. This and this, relative to this, tells us that the present day trends from a mathematical perspective and from multiple time frames, the present day is stronger mathematically than this period here and this period here, telling us that we have a higher probability of any pullback being bought, and the duration of a pullback should be shorter from a probability perspective, and the magnitude of a pullback should be more shallow relative to the odds or probabilities here when we had a weaker trend. We can also see long-term consolidation in the S&P 500's 100-day moving average here is in the box for almost 16 years. Typically, when we get a breakout, good things happen for a long period of time. Good things happen for a long period of time. We recently had a breakout, and we're holding that breakout as of April 28th. There's no question we've lost momentum on the short and maybe intermediate term charts. How about the long-term charts? Remember our bullish MACD cross here. It's still in place as of April 28th. And we know these bullish MACD crosses on a monthly chart are relatively rare, and typically good things can happen for a long period of time. Revisiting the TSI analysis that we performed a few months ago, just like MACD, it helps us monitor long-term momentum. From a magnitude perspective, when you get the bullish cross, good things can happen. From a magnitude perspective, good things can happen. From a magnitude perspective, good things can happen. We still have the bullish cross in place as of month end April 2017. So far, our long-term Bollinger Bandwidth analysis appears to be in place. Good things are supposed to be happening here. The S&P 500 rallied and was able to post a 21-point gain in the month of April. When we're down here, this is very, very rare. This is 1982. When we turn up, good things can happen for a long period of time. When we turn up from very low levels, good things can happen. Turn up, good things can happen. Right now, this is still in place and helps us assess longer-term probabilities. Earlier in the year, we also did an analysis with monthly RSI. When monthly RSI rallies around the midline at 50 and then goes into overbought territory and stays for the most part there, good things can happen for a long period of time. Rallies around 50, stays there, good things can happen. Similar situation in the present day. We rally around the midline in calendar year 2016 and 15, and then we've come up and we remain in overbought territory at month end with monthly RSI closing at 73. Our 30, 40, and 50 week, for illustrative purposes only, moving averages still have a full bore bullish look as of April 28th. And maybe more importantly, the present day doesn't look anything like this low probability look here in calendar year 2000, nor does the present day look anything like this low probability look here early in calendar year 2008. After we could see this and measure it in a model, really bad things happened. The S&P 500 lost an additional 52%. History, at least from an anecdotal perspective, tells us if a market goes sideways and consolidates and gets a bullish breakout, and it's accompanied by one of these bullish turns from a long-term perspective, a market goes sideways, it breaks out, and it's accompanied by a bullish turn, good things can happen for a long period of time. A market goes sideways, breaks out, it's accompanied by a bullish turn, good things can happen for a long period of time. Our goal is to get from point A to point B, from point A to point B. There are two constants from point A to point B. Number one, for the most part, we maintain a full bore bullish look from point A to point B. We maintain a full bore bullish look with our moving averages from point A to point B. Another constant, we know with 100% certainty the market will not make it easy to get from point A to point B, especially emotionally, because we know volatility is going to be part of the equation. Maybe a lot of volatility, and that's what the model and the moving averages and the risk-on, risk-off ratios help us with. Discerning between volatility to ignore, and eventually we'll see volatility to respect where action is required. some things that can help us get from point A to point B, especially when the inevitable volatility rears its ugly head. Common missteps: watching the market too closely. We don't need to check the market every 3 seconds or every 3 minutes or even every 30 minutes or even every day. Watching your profit and loss too closely. Here's a big one: checking your account balance frequently. It gets you focused on the short-term volatility rather than the long-term trends. Overtrading your account. It's very, very difficult within the context of a strong bullish trend to add value by trading during the periods of volatility. Statistics tell us that most likely we will destroy value if we try to trade during these bouts of volatility. Other common missteps, we've seen an example of this recently: lack of patience. The market has been in one of those inevitable drawdown periods. It's not easy to stay with the game plan. It requires patience and discipline to avoid these common missteps here in trying to own everything. It's not possible to own every single ETF that's trending in a positive manner. It's also not possible to be right 100% of the time. If you want to be right 100% of the time, and you want to feel comfortable 100% of the time, the stock market is not the place for you. We know in advance when we try to move from point A to point B that we can't own everything. Inevitably, there will be periods where we feel like we are wrong, and it's not possible for every single leader to lead 100% of the time, to lead every day, every month, every quarter. Leadership, like everything else, has a primary trend, and it has normal and to be expected counter-trend rallies. When things are going well, as they have been in recent months, it's very, very easy to forget that things were dicey as recently as November 2016. This is the start of the bullish trend. However, this looks like a failed bullish breakout before the election. And we know that failed breakouts can sometimes move rapidly in the other direction. We also have to keep in mind, in the early stages of this trend, the futures went limit down the night of the Brexit referendum, and the futures also went limit down on election night. Harder markets are typically followed by easier markets. And since election night, the math and the trends have been easier than this sideways period here. As long as this is the case, we will err on the side of remaining fully invested. Why? Because typically after a long consolidation period, harder markets are typically followed by easier markets. And the term easy is a relative term. The market is never going to make it easy to get from point A to point B, because inevitably there will be volatility along the way. The model helps us discern between volatility to ignore and volatility to respect. With the benefit of hindsight, it looks easy to get from point A to point B, but we're all human, and the common missteps can cause us a lot of heartache and pain between point A and point B. Sometime in the last few months, you might remember we used the 100, 200, and 300 generic moving averages for illustrative purposes only to help us understand volatility to ignore and what volatility to respect looks like. From a trend following perspective, and this really applies to any time frame, this is the look we want to avoid. This is a low probability look. This is a higher probability look, and the look that typically forms at the start of a new long-term trend when you're using long-term moving averages. So how do these moving averages look at month end April 2017? Does it look like the start of a new bear market or a new long-term downtrend? Or does it look more like the start of a new long-term uptrend? These are the exact same generic and, for illustrative purposes, only 100, 200, and 300 day moving average as of April 28, 2017. And we can see this looks a lot more like this or this This here, the present day, really doesn't look anything like this period here. Is it possible for this to morph into a look like this? Absolutely, positively, yes, but we do not forecast that. It's possible, but the key for us is it hasn't happened yet, and we make decisions based on hard evidence, evidence in hand rather than forecasts about an extremely uncertain future. We know our long-term trend following techniques, something like the 200-day moving average, can help us discern between volatility to ignore and volatility to respect. We can also use trend following techniques, the 200-day moving average, with risk on, risk off ratios, and we can use it to look at asset class behavior. Asset class behavior can also tell us, does it look like the early stages of a new bear market? Does it look like the early stages of a new long-term downtrend? And is asset class behavior shifting toward a defensive bias? So let's apply our 200-day moving average to some ETFs and see what we can learn relative to those questions. Risk on, risk off, SPY relative to TLT, April 28th. This is the 200-day moving average. The slope of this really doesn't look anything like these concerning periods here. How do growth-oriented base metals look relative to bonds, TLT, from a long-term trend perspective on April 28th? Here's your answer. Small caps risk on relative to defensive bonds, risk off, April 28th. Here's your answer. Transportation stocks relative to the VIX. An equal weight S&P 500 index, RSP, relative to GLD, or physical gold. Technology stocks, the triple Qs, relative to bonds, TLT. Industrial stocks relative to bonds, XLI, relative to TLT. Like every trend that we've looked at, this is the primary trend. From a leadership perspective, you are going to have counter trend moves within the context of the primary trend. Our focus is the primary trend. Growth-oriented Russia, which is part of emerging markets, relative to more defensive-oriented gold. Here's our 200-day moving average, April 28th. DXJ, Japan, hedged relative to defensive-oriented bonds. This looks like the early stages of a new long-term trend favoring DXJ over TLT. We're not using this to forecast. It doesn't tell us how long this trend will remain in place. It remains in place. That's a fact. No forecasting needed. It remains in place as of April 28th. Consumer discretionary stocks relative to TLT. And if we want to flip it around, how about defensive? Should I be in defensive consumer staples relative to SP high beta, defensive relative to growth? The slope of this line and this turn here, does it look more like the bullish periods, or does this turn here look like one of these concerning periods here? The answer is easy. It's right in front of us. Defensive healthcare relative to growth-oriented banks, XLV relative to KRE, April 28th. This ratio recently experienced a breakdown, and a common theme is these 200-day moving averages are turning either down in this case or up. And all of it is typically occurring near Election Day 2016. We get a bearish turn in the 200-day near Election Day 2016. Defensive-oriented utilities, XLU, relative to the broad market, or VTI. How about PE ratios or valuations? Should we be concerned? I'm not sure. I'm not sure how helpful they are. These are PE ratios here in the present day. We're floating somewhere around 25. Well, we can be in the 20s within the context of an ongoing trend. We can be in the 20s within the context of an ongoing bullish trend. We can be in the 20s near a peak. We can be in the 20s at the early stages of a new trend. And we can be in the 20s at an early stage of a new trend. It's very, very difficult to see how PE ratios could have helped us time entries and exits. This chart contains no opinions. We have simply added PE ratios to the chart. From the book Market Wizards, I never use valuation to time the market. I use liquidity considerations and technical analysis for timing. One of the ways that we monitor trends, and more importantly, the health of our ETFs, is to look at normal retracements within the context of an existing trend. Regular viewers and clients might remember that we covered these concepts before the U.S. election. The analysis said that we had this A to B move here, a normal and 100% to be expected retracement within the context of an ongoing trend might come back to the 38.2% level, the 50% level, or the 61.8% level. As long as we stay in this range, what does it tell us? It tells us the probability of making a higher high is still relatively favorable. Why? Because this looks like a normal retracement within the context of an ongoing trend, and that's what trends do. Bullish trends make a series of higher highs and a series of higher lows. What happened next in this case after this gut-wrenching retracement here? The market rallied within the Fibonacci retracement zone and eventually went on to make a higher high. This still looks like a bullish trend as we headed into 2017, and this looks like a normal pullback within the context of an ongoing trend. How concerning is the recent pullback in crude from a Fibonacci perspective? We rally off the February low. Our high is in early 2017, late 2016, and right now this looks like a normal retracement within the context of an ongoing bullish trend. Step number 1, break a trend line. Step number 2, make a higher low. This is a higher low relative to this low. Step number 3 for a trend change from a probability perspective is to make a higher high. This is a higher high relative to this high. We're not forecasting anything here about what's going to happen next. This just doesn't look that bad as of April 27th, 2017. How about the VIX? How concerning is an 11 or 10 reading on the VIX? And that's where we are in April of 2017. From an anecdotal perspective, here is the VIX between 10 and 11, 1, 2, roughly 3, 4, 5, 6 times in this period here. So we have a very, very low VIX. We could make an argument that's a sign of complacency and bad things are about to happen. During this entire period here, the stock market gained over 30%, and the VIX wasn't particularly helpful in terms of forecasting what might happen next from a long-term perspective. This blue line is basically the exact same level the VIX is trading at on April 28, 2017. How about the broad Wilshire 5000 stock index? This is weekly, April 28th. This is the close. Here's our bullish breakout from a consolidation box. And if we flip over to a version of the chart that only shows closing prices, you can see we just made a new weekly closing high. This week's close on April 28th is above this high here. This right now looks like a normal retracement within the context of an ongoing bullish trend. During a bullish trend or a move from A to B, the givebacks or the volatility make it very, very difficult to stay with the long-term trend. That's where the trend following techniques come into play. This is the 200-day moving average here. It's much, much easier under our approach if we focus on the trend following techniques rather than volatile and toss and turn at night price in isolation. You may remember in early March we did an analysis and said, based on some similar historical profiles, a normal pullback within the context of an ongoing uptrend could come back to any one of these levels. If we fast forward to April 28th, so far we remain within the normal retracement or give back level based on that historical analysis. Some monthly chart of the value line geometric index. It's 1982 here, 1983 price, similar area, 1984, 87, 1990, similar area again in 2009. Resistance 1998, resistance 2007, resistance 2016. Note, this is not month end, it's April 27th. Stock charts had not posted month end. Looked it up, it was up for the month. Last month it closed at 520. This month it closed at 524, so it was up roughly 0.8% this month, and it is still holding above the orange box here. The longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. The longer the breakout holds, the more relevant it becomes. The facts that we have in front of us today says the breakout is still holding. Like anything else, the only way we can use this chart and the model effectively is to maintain that flexible, unbiased, and open mind. So when volatility to ignore inevitably flips over to volatility to respect, we can act accordingly. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.